All right, welcome to this explainer. Today, we're going to put on our mechanics overalls and pop the hood on IBP, a massive multi-billion-dollar company. We want to diagnose its true underlying financial health. You know, in today's market, growth can sometimes just be a mirage built entirely on cheap debt. So we are just glancing at the shiny paint job here. We're breaking down the hard data to see exactly how this engine runs, and more importantly, if its incredible run is actually sustainable.
So let's just dive right into this jaw-dropping 10-year return figure because honestly, it immediately demands our attention. 1,054.66%. To put that kind of massive growth into perspective, if you had taken a standard $10,000 initial investment a decade ago and just held on, it would have morphed into well over 100 grand today. We are talking about a massive compounding wave of wealth creation that completely dwarfs the broader market. That's not just a good return, it's literally a portfolio-defining one.
Now, the obvious question on everyone's mind is, how exactly did IBP pull off this staggering 10-year return? And, the even bigger question for us today, is it too late to buy in? Well, we're going to unpack this whole mystery right now. We'll systematically look at their historical momentum, then dissect their underlying profit engine, and finally look at their current sticker price to see if the valuation still makes any sense in today's environment. Section 1. The 10-year powerhouse. Let's start by looking at how they actually built this massive momentum. What we're witnessing here is a dramatic, and I mean dramatic, acceleration in returns. This isn't your standard, steady, linear growth. If we look at the total return compound annual growth rate over a 5-year period, it sits at a very respectable 18.86%. But watch what happens as we zoom in on the timeline. Over the last 3 years, it jumps to 34.83%. And in the trailing 12 months, a blistering 68.84%. This momentum is compounding massively right now, which tells us there's a serious underlying catalyst driving all this market sentiment. But here is where things get really interesting. Normally, when you see a stock accelerating at that kind of hypergrowth pace, you'd absolutely expect skyrocketing sales to be the main driver, right? But check out this divergence. Recent trailing 12-month revenue growth is actually almost flat. We are talking a meager 1% growth. Top-line sales are barely budging, yet the stock is behaving like a rapidly scaling tech startup in the middle of a global rollout. So clearly, the secret sauce to their skyrocketing success isn't just selling more stuff or expanding their footprint. Section 2. Under the financial hood. Since massive top-line revenue growth isn't their big secret, let's dive into the internal engine. To really understand this wild divergence between flat revenue and an exploding stock price, we have to look directly at management's financial efficiency. And a great place to start is return on equity. Look, when top-line growth stalls out, the only way to exponentially grow shareholder value is to become utterly ruthless about how efficiently you use the capital you already have. ROE basically unravels this mystery for us, showing exactly how well management is wringing net profit out of every single dollar of shareholder equity. And boom, here is where the engine really roars to life. They're sitting on an insanely impressive 37.39% ROE. To fully grasp why hitting nearly 40% is just extraordinary, keep in mind that average market returns usually hover around the low double digits. Anything consistently over 15% is generally considered really strong. So sitting up near 40%, that proves IBP's management team is operating at an elite level of capital efficiency. They don't even need to aggressively double their sales footprint when they are this profoundly good at turning existing capital into high-yield returns. Let's expand our view a bit and bring their debt load into the picture by looking at return on invested capital, or ROIC. If ROE shows us how they treat shareholder cash, ROIC gives us the broader picture of how effectively they deploy capital across the entire operation, leverage included. It basically tells us if the massive investments they're making internally are actually paying off at a premium. And it turns out they absolutely are. Their ROIC sits at a very robust 19.31%. But the real takeaway here isn't just that snapshot, it's the trajectory. That 19.31% represents a near 8% improvement over their own 5-year historical average. So the internal operations are actually getting leaner and more profitable as time goes on. Having an operation this lean is a massive advantage. It means they can easily weather macroeconomic downturns, and it frees up a ton of cash to fund aggressive shareholder perks, like buybacks. When we translate all of that into actual profit margins, this engine looks exceptionally well-tuned. They're pulling in a gross profit margin of 33.75%.
And what's really impressive is the bottom line. They maintain a super healthy net profit margin of 8.62%, and that's after all operating expenses, interest, and a hefty 25.66% tax rate are completely paid out. Generating that kind of net margin while carrying a high corporate tax burden, that is a huge testament to how flawlessly management is controlling its operational costs.
Moving right along to Section 3, dividends and debt. Time to inspect the chassis of this business, its overall safety, its debt load, and how it directly rewards investors. Okay, so a low dividend yield of just 0.54% might look a bit unappealing at first glance, right? Especially if you're an income-focused investor hunting for yield. But context is everything here. They have a payout ratio of only 15.40%. That means they have an absolute ton of cash left over to aggressively reinvest and grow the business, all while easily maintaining a 5-year streak of consecutive yearly dividend increases. Think about the psychological benefit of that. You're holding a stock that delivers 5 years of unbroken dividend growth right alongside staggering price appreciation. Sure, it's a small slice of the pie, but it is an incredibly secure one. Taking a peek at their leverage, the debt-to-equity ratio is currently 1.26. This is a clear, blinking indicator of a company that is actively and strategically managing its risk. That 1.26 figure is actually down nearly 20% compared to their 5-year historical average. They are organically paying down leverage. In a macroeconomic environment where high interest rates are just absolutely crushing heavily indebted companies, shrinking that debt burden gives IBP a massive competitive moat. It makes the whole enterprise so much less vulnerable to unexpected economic shocks. And that safety is compounded by their current liquidity, a current ratio of 3.03 and a quick ratio of 2.44. Those are fantastic numbers. These metrics mean they possess nearly 3 times the short-term assets needed to cover their short-term liabilities. Simply put, if the entire economy ground to a halt tomorrow, IBP could pay off every single immediate bill without breaking a sweat and without needing to liquidate long-term assets or take on toxic emergency debt. This is what a highly secure financial fortress looks like. Finally, we arrive at Section 4. Is the price right? We know the underlying business is stellar, but a great company can still be a terrible investment if you pay way too much for it upfront. So we're going to use the PE ratio to see exactly how much of a premium the broader market is currently demanding for a slice of these highly efficient earnings. Let's see if this operational excellence is already completely priced in. So, IBP currently trades at a PE of 29.66. Now, historical context is absolutely crucial here. That multiple is roughly 23% higher than both their 3-year and 5-year historical averages. What does that mean? It means the broader market has clearly woken up to how relentlessly efficient this company is, and they've slapped a significant premium price tag on the stock. You are essentially paying a high-flying, tech-level growth valuation for a company that, as we saw earlier, is experiencing nearly flat revenue growth. So make no mistake, you are unequivocally paying up for quality here. However, the narrative gets quite a bit more complex when we look at intrinsic value. When we run the discounted cash flow metrics, which basically project future cash streams and discount them backwards at today's value, a really fascinating picture emerges. Strong future cash flow projections are actually outpacing those high current earnings multiples. Because of this, despite the high PE ratio, the current trading price of $288.55 still sits below our calculated fair value price of $319.60. That actually leaves us with a calculated margin of safety of 9.72%. The rigorous cash flow math is telling us that even at this historically high multiple, the stock might technically still be undervalued based on the cash it's expected to generate. And that brings us to our final crossroads. We've seen it all today: the incredible internal efficiency, the fortress-like balance sheet, the shrinking debt, and those truly staggering historical returns. But we're also staring at a stock trading well above its historical valuation averages, demanding a serious premium from anyone stepping in today. So I'll leave you to consider this. Is that nearly 10% margin of safety really enough to justify buying in at such historically high valuation multiples? Is this an unstoppable value play that still has room to run, or a brilliantly disguised growth trap? Thank you so much for joining us on this explainer. And remember, keep exploring the data.